Good morning, folks. Welcome back. So, recently, Jerome Powell gave an announcement speech that it seems like the Fed is going to continue to keep lower interest rates. Now, if we look at Polymarket, they believe with 95% confidence, with $79 million, that we are probably going to have another 25 basis point cut in October. So I think that that's going to indicate just how tricky the situation we're currently in, because we have a lot of unemployment. It's, I think, around 4% right now, and it seems like it's going up. Look how the Fed decision in December is also likely going to be another 25 basis point decrease. But this is causing inflation like crazy. And this, I think, is one of the biggest reasons why gold prices are going up. Look up here in the top right corner. The price of gold, people are predicting to be at different values now because they realize it keeps shooting up. 85% think that it's going to close in at more than $4,000. That's pretty crazy. Now, this only has 417K in volume. I would wait until this sees a couple million in volume to be more confident about what's going on with gold. But it makes sense when you think about it, because everything in the world is being inflated. Lots of things are tied to the US dollar. So what do you do when everything is losing actual value or getting more expensive? When I say things are losing actual value, I mean like your job, for example. If you make 100K in your job and inflation is eating away at it, you're not even you're not adjusting your raise for inflation if you only get a 2 or 3% raise. Because if inflation is 3 to 4%, let's say inflation is 4% and your raise is 3%, you're actually losing money. So even though you stay in the same job, you're doing the exact same stuff, you're getting paid less to do that. Where do you put your money then? My brother has this saying that he heard, or maybe he came up with it: cash is trash. Just hold gold. I like that saying. And I think that it's something that makes sense when you look at how gold has been doing. Look at this. In the past year alone, it's quadrupled, 400%, almost 400% in the last year, 1 year. Now, if we zoom out during the COVID days, this is 2020, this is 2021, you can see it really shot up right here. This is all because of inflation. Now, is there going to be a big crash in gold? That seems very likely considering how fast it's moving up. But at least until the interest rates stop getting cut, what are banks around the world going to do? They don't want to hold US dollars because US dollars are starting to lose their value relative to other currencies. So what all of these foreign banks internationally are starting to do, and because of the way that the US is politically positioning themselves with everybody else, people don't really like the US and they don't like all these tariffs that they're doing, even on their allies. So what's happening potentially because of partially that, but also mainly because of all of the interest rate cuts that the Fed keeps introducing, is that you have this massive inflation, and a lot of local economies, like let's say in third world countries or in places that tend to not have a lot of GDP, will be severely impacted by the inflation, just like after COVID. Those people will be experiencing massive inflation, and those people are too poor to afford those prices, which means their livelihoods are going to be a lot harder. The rich get richer. So, what do we do to protect ourselves and our assets, our wealth? Stocks are a relatively good option because when you look at what the actual value of these companies is, you realize that they can just raise prices on whatever it is they're selling or the services that they provide, and everything ends up balancing out. So they're still able to make either the same profit or sometimes even more profit. Say, for example, with shrinkflation. where consumer product goods like shampoos and snacks shrank the amount that they gave you, but they increased the price. So they made record profits during COVID. Part of that is due to inflation, but you have to understand record profits, it could also not be actually that impressive if we do inflation adjustment. But when everything is being inflated, you have the prices of houses going up, you have gold being a massive center of what some people consider value to be held, specifically because it's more stable than US dollars. And you have equities going up as well. So holding on to cash when inflation is going to keep eating away at it like moths is a really bad idea. At the very least, I think gold is what a lot of people want to invest in because it's a lot more tangible what its actual value is. If you look at the way that these semiconductor companies and AI companies are operating, one of the semiconductor companies will pay an AI company to buy their chips. It's a cycle. And this is starting to sound like one of those Enron scams scandals that ended up causing a massive bubble pop. I'm very skeptical of the technology space right now because there's a lot of that hype. Now, that's not to say that that hype isn't necessarily justified. Look at the dot-com boom and bust. In the early 2000s, all these people were trying to get onto the internet, and most people lost. But the few companies that won, they own the world now. Who doesn't use Google? Google is literally on this screen. I'm literally preparing for an interview with Meta. I use Meta, Google, Apple every single day. This is all being recorded on an Apple laptop. So you can see there are going to be a massive number of setbacks. There's going to be a bloodbath of all these companies that fail in the AI space. But the ones who stand strong and the ones who end up winning are going to take everything. It's winner take all. They will establish a monopoly. This current administration isn't big on antitrust. In other words, they aren't pursuing monopolies and trying to break up monopolies a lot. So there's a lot of corporate consolidation going on. And this is actually true. I shouldn't say just this administration. In the past 20 years or maybe even more, past couple decades, there's been a lot more corporate consolidation. Lots of, maybe just the past 10 years actually. A lot of companies buying each other up rather than trying to invest in novelty and creativity. So with that being said, we have to think about who are the next winners going to be? Who are going to be those big names in the future? Now, if you have a crystal ball, that's pretty easy. But unfortunately, I don't, and I have to think carefully about what the future looks like. So Applied Digital is a company that's focused on data center operations. And part of that is driving their remarkable surge. We see an 80% surge recently in the past month or so. Yeah. And part of this is because they're starting to close contracts with some of these larger companies. But I think what's so interesting is that many of these companies are going to have to fight each other to gain those contracts for the data centers. Now, we have to see who the winners are. Right? So maybe Applied Digital only gets a few contracts and they end up losing out more to other people who have more ability to close contracts. It could also just be a meme stock too. There might be so much interest by retailers that they're just pumping up the price. When we look at the stock market in general, we can see there's lots of things that get pumped like crazy, especially at times like this. Over here on the right, some of these are interesting, like SoundHound and I don't know. This is just NASDAQ, but these, I think, if I recall correctly, this one is more AI focused. This one rhymes with spaghetti, so retail traders love this. Rigetti spaghetti. But you can see they're down 8% in just one day because this is probably mostly just a meme stock. So I think it's important to understand value. What is the value of the company right now, and what small cap companies are going to probably end up getting a niche or building out some novel direction that ends up being really valuable to the business world? That's something that I would challenge each of you to go and look for on your own. I personally will share another one that I'm interested in, but again, this isn't investment advice. This is just my own personal thoughts. Navitas Semiconductor. So one of the things about all these semiconductor companies is that they're constantly getting a ton of requests by all of these AI companies for more GPUs, more graphical processing units. Now, recently, Navitas partnered with NVIDIA, so that's really awesome. There's potentially a lot of revenue that they can generate from that partnership. But little companies like this, the ones who work on the semiconductors, the ones who work on the data centers, the ones who supply the electricity for the data centers, those are going to be the winners, because those are the shovel and pick sellers of the gold rush. The people who may not necessarily find gold, these AI companies, because they're the ones who have to do the hard work of data mining. As a data scientist, I can tell you right now that mining for that data is difficult. It's arduous. There are potentially things you can gain from the data, which is really awesome, and you definitely want to be able to do that at scale. So yeah, using a lot of compute makes sense. But at what point does it stop being worth it? If everybody wants to mine on this data and try to figure out how to get LLMs to maybe talk more naturally, or how to specifically think about things in a certain way, well, that's going to take a lot of compute power. And is NVIDIA going to be the only one that controls those semiconductors that get sold to people? We may be approaching a space where people start saying, we don't care, we want any GPUs. It doesn't have to be from the NVIDIA or AMD, or it doesn't need to be from, et cetera, et cetera. Now, if you look at the supply chain carefully, there are still some bottlenecks, like I think lithography is one of the bottlenecks to semiconductor processing. So unless you can scale up that process, or you can make sure that the supply chain is more resilient, it can be really hard to gauge, first of all, who's going to win, and who will end up having more value in the long run. Google itself has internal hardware called TPUs. Google TPUs are tensor processing units. These are custom designed for AI accelerated learning. How does that compare against NVIDIA? Will Google potentially scale that up and start selling that to other AI companies? I think that Google is actually a pretty safe bet, because not only do they have a 10% investment in Claude investment, Google, yeah, so they invested in Anthropic, who yes, they have a 10% ownership stake in Anthropic, and Anthropic owns Claude? Yes. Yeah, they own Claude. So if you want exposure to Anthropic, Google is a great way of doing that. Not only this, but Google in general has been this sleeping giant, where they were, for many years, pretty complacent and pretty much just sitting happy with their monopoly on search. Now, with AI taking over the scene, you have groups like Perplexity AI and Claude and all these other different AI who are starting to replace search. And that is a massive red flag to Google, to Alphabet. So Alphabet has a very strong incentive to try to come in and make sure that they kill the competition on this AI race. They have the resources. I frankly think that they either kind of have the talent or they can get the talent. And I think that they are well positioned to at least be one of the front runners, especially because they have things like Google Cloud Platform, and they have all of these people who used to work at Google, like DeepMind. They can potentially lure those people back with better benefits and stuff like that. You hear about them paying some engineers not to do anything because those machine learning engineers are so valuable. It would hurt them if those specific people went to work at other companies. So you see a lot of interesting things like that happening. Well, I think that's all for today. I went on and on a little bit about a couple of different areas. Hopefully some of this was useful and interesting. I'm going to continue to follow what's going on with the Fed decisions, and I'll try to continue keeping you updated on how the markets are doing. Just an update on my last video. I talked about how I had lost a lot of money and how that was actually something that psychologically kind of got to me a little bit. I think I said I lost it was like 60K or something. Well, today I have unrealized gains of 20K, and if I sold at 8 a.m. Pacific time, I would have been up 28K just in one day. So I think it's really important to keep in mind this mentality of psychological resilience and this is a big if you have appropriate risk prevention or risk mitigation techniques. So one of the things that makes me very safe about the profits I'm making is that I am currently mostly playing very long options. Those long options that I hold are something called leaps. So leap options usually are options that you hold for more than a year. So it's like a coupon that doesn't expire for at least a year. And it's a really cheap way of leveraging and optimizing your capital use. That's what some people feel. I personally think it's really about making sure you choose the right stocks, because if you think that it's going to go up, but you don't know when, then it's great to try to capture it by doing these leap options. Again, one leap option, let's say you buy a call. A call means that you have the privilege of buying 100 shares at a certain price whenever you want. But you pay for that coupon. You pay for that privilege. So let's say they say, okay, this stock is $100 right now, and you can buy options that allow you to buy this stock at $110. But you don't just buy one stock, you get to buy 100 stocks. And if you can't afford that, then you just sell it to a bank or sell it to some bigger person who is able to actually go and buy all of those. And they will pay you basically what it's worth, minus a little bit, because they're the ones executing the trade. So if, let's say the stock price is $100 now, and let's say I pay $1,000 to buy this coupon that says I get to buy at the price $110, 100 shares 1 year from now. And that's the expiration. Well, guess what? 1 year from now, maybe that stock goes up by $50. So the stock is trading at $150, which means if I were to exercise the option, then I would get 100 shares at $110, and I could sell them at $150, which is the current price. So I made $40 per share. 40 times 100, that's $4,000. So I spent $1,000 and I made $4,000. That's a 400% return within 1 year. Now, that sounds pretty great, but let's keep a couple things in mind. Number one, the stock must go up to at least 110 for me to break even. And even if actually it has to go beyond 110 to break even, because I already paid $1,000. So if it goes, let's see, 100 shares, $1,000. So that means I need it to go up to $120 per share in order for me to actually break even. The current price is 110. If it doesn't go up to 120, if it only goes up to 105 or 109, my options expire worthless. Now, there might be a little bit of momentum there. So when it gets to 109, maybe my options are actually worth a little bit more than I paid. And then I can get out at that time if I don't think it's going any higher. But generally, options are very tricky because you have to get the timing correct. If you end up buying a whole bunch of options that expire really soon, there's something called theta burn. So it's basically the price of your coupon goes down the closer to expiration date you get. Let's say you have a coupon for yogurt and it expires tomorrow. That's probably not as valuable as somebody else who has a coupon for yogurt and it expires 1 month from now because they have an entire month to wait, and maybe this weekend they couldn't go, but next weekend they can go. But if it's going to expire tomorrow, well, tomorrow you have yoga. Tomorrow you have to go visit your aunt. Tomorrow you don't know if you can make it because you have physical therapy. So this is why the price of the coupon goes down as time goes on. And the closer you get to expiration, the faster you lose the price of the value. That's why I lost so much money on options when I had some options on SP500. My options expired on a Wednesday, but 4 days away from the expiration date, my options were losing their value like crazy fast. And so when it got to, I lost 30% of the value that I paid for, I said, that's it, I'm out. I'm going to cut my losses. And that kind of discipline is thankfully what prevents people like me from going to zero. And, that terrible mentality where it's like, oh, I got to just keep holding. It's a sunk cost fallacy. To think, oh, I'm losing so much, I might as well just keep holding it. No, because you still have something there. You have to make sure you pull that out before you lose everything. Now, on the flip side of that, I actually wasn't as disciplined as I should have been because I should have set better constraints. I should have said, if I lose 10%, if I lose 20%, then I need to be okay with that. Clearly, I lost 30% and I was not okay with that, which means next time I need to be more conservative with how much losses are acceptable to me. All right. I'm really glad that we had that conversation. Just want to make sure that people understand risk adjustment because there are lots of risks to investing. Don't lose your shirt. Don't lose all your money. Be careful out there. Thank you for following. Catch you in the next one.